Hey, good morning once again, options traders, and anybody who's followed this channel for a while knows that I will occasionally do some technical indicators, some oscillators, and every once in a while we'll talk about some candlestick patterns. So one that I think is particularly important for these markets because they can certainly give you a head fake is called a Tasuki Gap. So what is a Tasuki Gap and why do you have to be cautious of this three candle pattern? Well, let's go take a look, and as always, please be sure to click like and subscribe. It goes a long way in promoting the channel. So, Tasuki Gaps. First of all, these are fairly rare, and this is another reason why you have to be careful of them because they can give you a real head fake. However, they are also higher probability. So we're going to start with an upside gap, or technically an upside Tasuki Gap, and what's going to happen here is you are going to have a strong bullish trend. So for example, let's say that yesterday's candle is a very long-bodied green candle, shows a strong continuation of the trend, maybe we even close at the high. And then today's candle, let's say, is a gap up, again with a long green candle, possibly closing at the high or pretty close to it. But then tomorrow's candle gaps down a little bit. And in fact, most cases it's going to be a red candle, but it doesn't fill the gap. That's really the big key, is that it doesn't fill that gap. Now, most people would see this strong bullish trend, yesterday's candle, today's candle showing very strong bullish signals, and then they see this gap down and they assume that that's a reversal pattern. But if it's a Tasuki Gap, it really means that the trend is going to continue from where it came. In this case, it would still be a bullish trend. So let's see what it looks like graphically. We have this long, pronounced uptrend, and the longer, the better. It's going to make the Tasuki Gap that much more powerful. And then let's say that yesterday's candle, again, is this long-bodied green candle, possibly even closing at or very close to the high. And then today's candle, we get this nice big gap up. So we've got this big gap right in here, and then tomorrow's candle, we get this red. But notice that it does take out the opening price. For a green candle, the bottom of the body, or of this box, is the opening trade. So it does take out that opening price, but it doesn't come all the way down here to the previous day's closing price. So we still have this little area here of a gap. So that's really the key, is that this third candle right here doesn't fill the gap. And that tends to be an indication that it's going to continue the trend. And so that's actually where Tasuki comes from. It's from Japanese. It's actually a decorative garment that they use for kimonos to support the long sleeves if they're not wearing them. It gives them something to tuck it into. So it has this connotation of supporting, and that's really what it's doing, is it's supporting this trend. So you can see where traders might get a little worried. They see this very long uptrend, yesterday's candle, long-bodied green candle, today's candle this way, and then we see the red candle, and too many times traders will say, let me go bearish, or let me start closing my positions. But if you see it like this, where it doesn't quite fill this gap, be careful. It probably means that the trend is going to continue. So let's take a look at an example. Here was the Invesco triple Qs, and you can see on this date back here, we had a green candle, gap up, and then there's the red, took out the opening trade, but it didn't fill that gap. And then we continued on in the same direction. So once again, they are fairly rare, but I just wanted to point that out for traders, because if you see that in these markets, maybe give it another day before you start to change your opinion about the direction. Now, of course, we have a downside Tasuki Gap. All of your candlesticks have an upside and a downside pattern. So it's going to be the opposite. We have this long, pronounced downtrend. Then let's say that yesterday's candle might be a long-bodied red candle. We might close at or very close to the low. And then today's candle gaps down. So think about what's happening. Downtrend, long-bodied candle yesterday, another gap down with a red candle today. Certainly looks like this trend is going to continue. But then we get this, let's say tomorrow. Changes color. We go to a green candle. Notice that it took out the opening trade right here. For a red candle, the top is the open. So it did go past it, but it didn't come up here and take out the close. We still have this little gap right in here. And that's an indication that you are probably going to continue in this downtrend. So once again, this is really the big key. You want to look that this third candle doesn't fill this gap. And so if you see that, it's a very good chance it's going to be a downside Tasuki Gap, and you might want to give it another candle or two before you start changing your opinion that maybe the market has reversed. Because if it is a Tasuki gap, you are far more likely to see it continue in the same direction. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.